All right, welcome to this video about an introduction to what we call a balance sheet. Now, be an active learner, take notes along the way. As I write on the board, you do the same, and hopefully we can share information that'll help you better understand this idea of what's called a balance sheet. So let me just start with the idea of what we're going to look at. And again, that is something called a balance sheet. Now, a balance sheet is a core financial statement in agribusiness. And actually, a balance sheet represents a time of the beginning of the business all the way up into today. So a balance sheet really encompasses the entire financial position of the business. Now, we haven't talked about financial analysis yet, but as a key financial statement, you can imagine that that is going to be one of the ways that we analyze how our business is doing based on the balance sheet. Now, prior to now, we've already talked about an introduction to accounting. And so as a business keeps records, it's got debits and credits, and all those debits and credits balance together, and they are all summarized in the balance sheet. So again, it's a very important financial statement for the business because all the records flow into it. It represents the beginning of the business all the way to actually today. So there's really no way to look at a balance sheet and be confused about the financial position of a business. It's one of the most important financial statements that businesses have. And again, our records, the debits and the credits, our record keeping, all the results flow into the balance sheet. So what are the sections of the balance sheet where all this information flows? It's divided into really three main sections, and I'm going to go into each one of those a little bit more. But the first section is assets, and these are items that we own. And so these are the business assets that we own. We'll talk more about those as examples because there's categories of them, and we'll go through those. Now, the assets that your business owns are equal to, and in fact, I'm going to draw a line because they're in a separate category. In fact, let's think about this. How do you own any item? So for example, let's say that I buy a tractor. Let me put that as an example here. So let's say I buy a tractor, and that tractor cost me, let's say it cost me $80,000 to buy the tractor. All right, so that's an asset or an example of an asset that you own. Well, that asset is equal to, in fact, it comes from, in your records, there's only two ways you can really get this. You either borrow the money, which in a balance sheet is called a liability. Liability. So this is our debts that we owe. So these are debts that we owe. So we might own a tractor, but we might borrow that tractor, and that would be using a loan. So let's say, for example, that our loan was, let's say, only $60,000. So we own a $80,000 tractor, and our records entered that as a debit. So we own that tractor. Now the credit would be that we borrowed $60,000 to buy that tractor. So you've got an $80,000 asset. You've only got a $60,000 liability. So there's more on this side of the balance sheet. There is something called equity. Now, equity is going to be kind of two categories. This is money we invest. So that's what equity is. It's money we invest in our business or we retain in income. So that means that we actually earned this money. So really it's money that we've invested or others have invested, or it's money that we've retained over previous years of making money. So if you put a $60,000 loan for an $80,000 tractor, then you must need to come up with $20,000 that you would have gotten from investors, or your invested money yourself, or you've created money from previous income. And so that is an example of what a balance sheet is. So a balance sheet, to review, and you've got your notes written here following along with me, I hope, it is going to be the assets that we own equal to the debts that we might gain, and I'm going to put that in red because that's kind of not what we want to earn a lot of money. We don't want to get a lot of our assets through just debt. We might also have got it from investors, or we earned it ourselves, which is really the way you want to go. All right, so this is the idea of a balance sheet. It's a financial statement that takes our record keeping, and all of those records fall into these categories. Now let's break out assets and talk about them a little bit more. Inside of assets, there are a couple of categories. So assets number one are what we call current assets, or I'm going to put a little space down, and I'm going to call this non-current assets. So this category of assets actually has two divisions. Now, what's a current asset? This is going to be items of, these are items that have value. Now I'm going to start with the word value. You have to be able to measure any asset's worth, and that's a value, a dollar amount. So these are current assets, and so these values are used, I'm going to put within 1 year, or what we call the operating cycle of our business. So current assets are values, they have value, and they're going to be either used within 1 year or the operating cycle of our business. What are some example current assets? A great example of a current asset is a bank account. Now, a bank account's not going to go away within 1 year. It's going to last for lots of years. But it's money that's going to get used up as part of the operating cycle or in 1 year of the business. Money will go out, new money comes back in. So current assets are assets that we're going to have value in, and they are used in that year or the operating cycle. What's another example of a current assets? And this might be developing heifers. All right, now developing heifers means that we probably have some beef cattle operation, that's our operation, and we put some heifers over into a developing area, and so instead of selling them on the market, we decide to keep them back in our business. Do they have a value? Yes, we place that value on them. Do they have, are they going to get used up within 1 year or the operating cycle? They may not get used up in 1 year. It may take us a while to develop them, like over 12 months. So we really look at, well, the operating cycle of that developing heifer is a little bit longer. Now, she is going to get used. She is going to either become a cow or she's going to get sold. So that's why she's in the current asset category. Now, what about, let me switch colors here. What about the non-current assets? What's the difference? Well, these are going to be values again. So the same idea, they all have to have a value. An asset has to have a value. These are values that are going to get used over 1 year or longer than our operating cycle. So what's an example of these? Well, the easiest one to follow is a tractor or a building. These are examples of items that have value, and they are going to definitely last longer than 1 year or even an operating cycle. Now, what's another good example is that is a breeding cow, or you could have bulls that fit within this category. The idea with this is to compare it to current. These developing heifers are young. They're just building, and they are going to grow and get operated into, or they're going to be managed into an operated capital item. And so they're either going to get sold to someone else, would just keep the income right back in the bank account, or they're going to get transferred and become the new category of a breedable cow. In other words, a breeding age. She's ready to be productive. Non-current items are productive assets that we use to manage our business. Current assets are productive assets, are productive items as well, but they have a shorter term value window. In other words, if you said to the business, hey, you need money right now, you need to gain some cash right now. Well, that would be money that we have in our bank account. We can use that right away. It's called a current asset. These developing heifers, they are young and developing. A set of market steers are young and developing, but actually at any time they can be sold for a good value. Now, if you come down here and look at these non-current items and you said to the business, hey, you need money right now. If you've got to sell a tractor, you're probably going to lose money on that. If you've got to sell a breeding age cow, you're probably going to lose money on that too, because these aren't items that are typically just sold at any point in time. You can sell them, they will bring you money, but you typically lose value on those. You lose money. So these assets really aren't meant to be turned over really quickly. These are. So current assets are going to be items that are going to be used or sold within 1 year of the operating cycle, or can be turned into cash really easy. And they don't lose much value on that. They're kind of got a good place to go. Non-current items, they are much longer term. They weren't bought to just sell. They were bought or obtained or transferred in, retained to use in the business. And they're really not designed to get just sold off right away. So that's the difference in our categories of assets. And as we keep our accounting records and our debits and credits, well, debits mainly, that's what flows into the balance sheet. So in fact, let me put a little mark by these. All current assets, or all assets, current and non-current, have a debit value. In other words, that's the positive for them. So anytime you do a record of a debit into an asset, you're showing that it's going up in value, and those are the categories. They're either in the current area or the non-current area. All right, what about liabilities? I'm running out of room here. Liabilities are a similar organization. You've got current liabilities, and then I'm going to skip a little room here down, and then you've got non-current liabilities. And so these current liabilities usually have a debt within 1 year or less, and the non-current liabilities are over 1 year. And so an example of a current liability would be an operating loan. So we needed some cash in our bank account, so we borrowed it as an operating loan, and so the current asset of a cash loan matches the current liability of an operating loan. So these things kind of need to line up. Now, what about if we borrowed money to buy our tractor like we talked about earlier? That would be an example of a non-current loan matching a non-current asset that we borrowed the money on. So typically current assets, if there's any borrowing, they are connected to a current liability. Non-current assets, long-term stuff, is connected to a long-term loan. So if you're going to borrow money to build a building, or you're going to borrow money to buy the land, you're going to borrow money to buy the tractor, then those are non-current assets and they match a non-current liability. If in business, you've got a current asset that somehow connects to a long-term loan, that's when things start to get out of balance. And as it won't get out of balance, your balance sheet will always balance, but that means you've got a management issue and something's going on in the business where it's a problem. So that's something that we always want to try to look at in business, is do our current assets align with current liabilities? Do our non-current assets align to non-current liabilities? Okay, and the last one, and I'm going to kind of make a little room. I'm going to shift over here. You keep going in your notes. The last one I want to talk about is equity. Now, equity is got two subcategories. I'm going to label that as an A and a B. The first category is the main one, and it is called retained earnings. Retained earnings is going to be all of our net income, all brought in together. So if in your first year of your business you make, let's say, $50,000 in profit, that means that you've got $50,000 extra in cash, and you didn't borrow money on it. So $50,000 in cash connects to $50,000 of retained earnings is what it's called. So this retained earnings is going to be every year our income from our business. So if in year one you made $50,000, then retained earnings $50,000. In year two, if you make, let's say, $60,000, then there'll be $60,000 of extra money in our income area, and that will match to another $60,000 in retained earnings, except it keeps accumulating. It's called retained earnings. It's all of the net income. So if you had $50,000 in year one, second year you make $60,000, now retained earnings is $110,000. Remember, a balance sheet starts at the beginning of our business all the way till today. So retained earnings just keeps accumulating. Now if you lose money, retained earnings will drop. So if you made $50,000, then you made $60,000, that's $110,000. In the third year, you had a big loss and you lost $10,000, that would pull retained earnings back to $100,000 even. So that's the idea of retained earnings. It's the most important section of our equity. Now, probably this may have even happened first, because when we first begin our business, we don't have any income, so it's called investor capital. Investor capital. Investor capital is owner money, or you could get it from investors. Now, what's the difference between an investor? What's the difference between an investor and a borrowing through the liability area? Well, when you borrow money, you always pay it back. So the goal is that you may acquire some assets and you have a loan, so they balance each other. However, over time, you want to take that money and pay that loan down so it gets smaller. And at the same time, we want our assets to grow. Well, how do you do that? Well, you do it pretty easy. You either make money, that's retained earnings, or you may have to get the money from somewhere else. Now, investors aren't people we pay back. So every dollar of an investor that goes into a business builds the assets, but the assets doesn't pay them off. We only worry about paying those liabilities. Investors are owners in the business. So if we own our own business 100% clear, that means we put the original money in the bank account as investor capital. So the money came in here and it's balanced in the balance sheet assets. Maybe we've got, let's say, $10,000 to start our business. So that's $10,000 would be in the investor capital area, and it would also be in cash, so we would be balanced. But what if we needed another $10,000? Then so we get an investor to give us $10,000. Now we've got 20 in the bank and 20,000 of investors. We own 50% of the business, they own the other 50%, and we are all investors. So we don't pay ourselves back in a debt, like a debt. We earn money in our business, and that builds our equity. All right, so those are the categories of the balance sheet in detail. Let me review again. Assets, things we own, two categories. Current assets, things we're going to use within 1 year or the operating cycle of our business, so it could be a little longer than a year, but those are called current assets. They have a defined value, and if we sell them, we can usually get exactly the amount of money that we felt like they were worth at the time. Now, non-current items, non-current assets, they are assets, but they are long-term. Things like tractors and equipment, breeding animals fall into this category as well. Now, these assets that we gain, we borrow the money maybe, or a portion of the value, and we either borrow with current money, meaning we have to pay it back with 1 year of the operating cycle, or non-current, meaning it's a long-term asset, and those connect to our asset categories as well as far as the loans. Now, you can't borrow all the assets you own. You have to have some skin in the game. That's called equity. Equity is retained earnings, the money we've earned in previous years. So the longer we're in business, the more we can grow retained earnings, or the more we should grow retained earnings. But right away, we don't have any money to start off with, so the money comes from what we call investors. That's what builds a balance sheet. I cannot emphasize enough that these values are all because of the record keeping that we kept. So every transaction that happens in a business is kept in our records. Those records flow right into the balance sheet because it represents the beginning of our business till today. So if you want to see how a business is doing today, look at their balance sheet. If you want to see how a business was doing a year from now, look at their balance sheet a year ago and compare the two, and that's how we can look at analysis. But that's for next week. This week is all about understanding the balance sheet. So hopefully this video helps you follow that concept. Again, take good notes, follow along, pause the video if you need, but hopefully this helps you better understand the concept of a balance sheet.